We can now move on to step 2. Go back to the framework that I provided you with. In step 2, we need to estimate our future cash flows and we need to calculate a continuing value. So first we are going to estimate our future cash flows and then we will calculate the continuing value. So first, when it comes to estimating your future cash flows, please note that our free cash flow is after tax paid. So please, this is not your tax expense as per your statement of profit and loss and other comprehensive income. It's not the tax expense. It's the tax that is actually paid. We want the cash flow. So it's after tax paid and it excludes depreciation and any other non-cash items. So that should make sense because we are trying to calculate cash flows. So anything that's not a cash flow must be excluded. Then any income or expenses that are not operating in nature must also be excluded. And the reason for this is because we are going to value non-operating assets separately. Then the last thing that we need to exclude is any interest on long-term borrowings. And this is because we are going to value debt separately. So please note, this is different to where we performed a valuation using PE multiples. When we performed the calculation using PE multiples, we used earnings after interest and tax. We did not value debt separately. Now we are using our cash flow before interest because we are going to value debt separately. So that's everything we need to exclude. Then, free cash flow includes your movement in working capital. And remember, the logic behind this is very similar to what we looked at with capital investment decisions. We are going to include sales and cost of sales in our calculation. Sales includes both cash and credit sales. So we take the movement in debtors into account so that we just have the cash portion. We are trying to estimate cash flows. We take the movement in inventory into account so that we don't have cost of sales, but we have our purchases. Purchases then consist of both cash and credit purchases. So we take the movement in accounts payable into account so that we are only dealing with our cash purchases. So remember, the reason why we take the movement in working capital into account is to convert our profit into cash flow. Then lastly, free cash flow also includes capital investments. So for example, if a company buys a machine, obviously that affects your cash flow. However, when you buy the machine, that's capital in nature, so it doesn't affect my profit. So because it's not sitting in profit, we need to take this cash flow into account so that we can convert our profits into cash flows. So when I talk about what the free cash flow includes, these last two adjustments here are so that we can convert our profit into cash flows. Then after performing this calculation, we will then calculate our continuing value. But let's first focus on the calculation of our future cash flows, then we'll look at the continuing value. If we go to our example, please note you are only including forecast information in your calculation. So 20x6 is ignored and we only include 20x7, 20x8 and 20x9. Now we are going to start the calculation with profit before tax, and then we are going to go through the framework so that we make all of the adjustments. So the first thing I told you is this must be after tax paid. So if I start with profit before tax, I'm going to have to deduct the tax that is paid during the period so that I can get my profit after tax paid. Then we are going to eliminate depreciation and any other non-cash items. We'll eliminate any income or expenses that relate to non-operating assets because we will value those separately. And any finance costs are also eliminated because long-term debt is also going to be valued separately. So if you look at our calculation, I'm adding back depreciation because I need to eliminate any non-cash items. I add back my finance costs because I'm going to value debt separately. And I deduct my dividend income because I'm going to value my investments separately. It's a non-operating asset. So where do all of these numbers come from? Go back to the statement of profit and loss and other comprehensive income. Here's my profit before tax. There's the depreciation that we are adding back each year. There's the finance cost that we add back each year. And there's my dividend income, which I deducted so that I can exclude it from my profit before tax. Then let's look at the calculation of tax paid. So I said to you, this is not the tax expense that's sitting on your statement of profit and loss and other comprehensive income. It's the tax that we actually pay during the period. So how do we calculate the tax that is actually paid during the period? First, you start with your opening balance that you owe to SARS. You then add your income tax expense as per your statement of profit and loss and other comprehensive income, and we then deduct the closing balance that is owed to SARS. Now, before we move on, I just want you to understand the logic of this over here. If I take my opening balance that I owe SARS, I add my tax expense for this year, and I deduct the closing balance, that's going to leave me with what I've actually paid across to SARS. So those are the first adjustments that we are going to look at. Obviously, your opening and closing balance that you owe SARS is going to come from your statement of financial position. So here's what I owe SARS. Now please note, this is my closing balance in 20x7, the closing balance in 20x8, and the closing balance in 20x9. If I want the opening balances for each year, this is the opening balance for 20x7, because the closing balance from 20x6 is obviously the opening balance for the next year. This is my closing balance for 20x7, so it's the opening balance for 20x8. And this is my closing balance for 20x8, so it's the opening balance for 20x9. So that's where my opening and closing balances come from. My income tax expense obviously comes from my statement of profit and loss and other comprehensive income. So there's my tax expense in each of those years. All right, so you should be happy with where all of those numbers come from. Then we need to consider the movement in deferred tax. Because remember, guys, deferred tax is not a cash flow. Deferred tax is an accounting principle. We don't actually pay any tax across to SARS, so there's no cash flow. So we need to eliminate this because we are trying to calculate the tax that is actually paid. So this is not a cash flow. Therefore, we must eliminate it. So once again, I want you to go back to your statement of financial position. where you were given your deferred tax balances. Now, obviously, the first thing you need to check is deferred tax can either be an asset or a liability. So please just first understand what you are dealing with in the question. In this question, we can see deferred tax is sitting with my borrowings and my equity, and it's being added to all of those. So we know these are all credit balances. So if I'm adding deferred tax to those balances, this must also be a credit balance. Okay, so we are dealing with a deferred tax liability. Then I want you to look at your journal entry, because if you understand the journal entry, you'll then know how to eliminate the deferred tax. So the journal entry that we would have processed from 20x6 to 20x7, we have an increase in our deferred tax. So my deferred tax liability is increasing. So if the liability is increasing, that means we are obviously crediting deferred tax in our statement of financial position. And we know the other side of this entry goes to profit and loss. So from 20x6 to 20x7, I have a movement of 280,000 Rand. Okay, so that is the journal entry that we would have processed. Now I'm trying to eliminate that. Now what you need to understand, included in this tax expense over here is deferred tax. Deferred tax is included in these amounts. So in 20x7, included in this amount over here, we have 280,000 Rand, which relates to deferred tax. Now, please note, your income tax expense is obviously also a debit. So if my income tax is a debit balance, we know the journal entry that was processed in 20x7, I'm just going to write the journal entry out again. We debited deferred tax in our statement of profit and loss and other comprehensive income, and we credited deferred tax in our statement of financial position. And we had a movement of 280. So that's what I did in 20x7. Now think about this logically. This is a debit balance, and I took a debit of 280,000 to profit and loss. So if I want to exclude or eliminate the deferred tax, I need to deduct the deferred tax. And then I will have the tax expense that excludes my deferred tax. Let's look at it like this. Here's my total tax expense. The total tax expense is 740,000. We know the deferred tax portion is 280. So the balance relates to my normal income tax or my current tax, which is 460,000. So by deducting the movement in my deferred tax, I've eliminated the deferred tax, and I'm now only sitting with my current tax, which is exactly what I want. Let's also just look at the calculation for 20x8 to make sure that you are happy with this. From 20x7 to 20x8, we have a decrease in our deferred tax balance. So if it's decreasing, that means I am debiting deferred tax in my statement of financial position, and I'm crediting deferred tax in my statement of profit and loss and other comprehensive income. And we have a movement over here of 210,000 Rand. All right. So now this is obviously going to work the opposite way around, because I am crediting deferred tax in my statement of profit and loss. It's now a credit. So previously, both of these were debit balances, adding up to this total debit. However, in 20x8, we have tax expense. The total tax expense is 950,000, and that is a debit balance. And that is made up of deferred tax and current tax. The deferred tax is 210,000. And please note, when we process that journal entry, we credited deferred tax in our statement of profit and loss and other comprehensive income. So that's a credit. My current tax is going to be a debit balance. So this balancing figure over here is 1,160. If I have a debit of 1,160 and a credit of 210, the net effect is a debit of 950. So remember, we are trying to eliminate the movement in deferred tax because it is not a cash flow. So I need to add the movement in deferred tax so that I'm only left with my current tax. And you can see if I add these together, I come back to the same 1,160. All right, and exactly the same applies in 20x9. So please look at that calculation. All right, so we start with the opening balance that we owe SARS. We add our income tax expense as per our statement of profit and loss and other comprehensive income. We deduct the closing balance because that hasn't been paid in the current year. We then eliminate the movement in deferred tax because that is not a cash flow. And we are then left with the tax that is actually paid during the year. Now, there's one other adjustment that we need to make. We said above that we need to eliminate the finance costs because we are going to value debt separately. However, we know when the company prepares their tax return, they get a tax deduction for interest. We know interest is tax deductible. So that means when they calculated this interest expense over here that's sitting in their statement of profit and loss and other comprehensive income, they would have deducted finance costs when performing that calculation. Now, if we are eliminating our finance costs because debt is going to be valued separately, we also need to eliminate the tax on those finance costs. So all I'm doing is I'm taking the finance costs for each year and I'm multiplying that by 28% so that we can eliminate the tax on the finance cost. Debt is going to be valued separately. Why am I adding this back? Remember, when the company does their tax return, they get a deduction for interest expense. So if we want to eliminate this, we need to add it back. We then have the tax that is paid in each of those years, excluding the tax on our finance costs, because debt will be valued separately. And you can then just include that in your calculation above. Go back to your framework. So we started our calculation with profit before tax. We deducted tax paid. We've excluded depreciation and non-cash items. We've excluded dividend income because we are going to value the investments separately. We've excluded finance costs because we are going to value debt separately. We now just need to include our movement in working capital and any capital investments so that we can convert this profit into a cash flow. So first, let's look at the movement in working capital. Go back to your statement of financial position. When we talk about working capital, we are talking about inventory, accounts receivable, and accounts payable. And you've got your balances over here for each of those years. Now, we just need to take the movement into account. So if we look at inventory first, inventory has increased by 100,000 Rand from 20x6 to 20x7. Now, if inventory increases, that means the company is buying more inventory. So if it increases, we have an outflow. So you'll see in our calculation we have an outflow of 100,000 Rand. Then it increases again by 600,000 Rand, so we'll have an outflow of 600,000 Rand, and then my inventory decreases to 1,500. So if it decreases, it means I'm selling the inventory, so that is an inflow of 200,000 Rand. Okay, so just make a note to yourself so that you remember. If it increases, that is an outflow. And if it decreases, that is an inflow. Accounts receivable is going to work in exactly the same way because it's also a debit balance. So if we look at accounts receivable, it increases by 300,000 Rand from 20x6 to 20x7. So if accounts receivable increases, it means your debtors aren't paying you. So that is an outflow. So in the first year, we'll have an outflow of 300,000. It increases again, so we'll have an outflow of 100,000, and then it decreases. And if it decreases, it means your debtors are paying you, so we'll have an inflow of 200,000 Rand in the last year. So an outflow, an inflow. The same logic applies. If it increases, it's an outflow. And if it decreases, it's an inflow. Now, accounts payable is a credit balance. So because it's a credit balance, it's going to work in the opposite direction. If we have an increase, that is an inflow. And think about it logically. If your accounts payable increases, it means you are not paying your creditors. So if you are not paying them, that's seen as an inflow. However, if it decreases, it means you are paying them. So that would then be an outflow. So we have an increase of 300,000 Rand. So if it increases by 300,000 Rand, we have an inflow. Then it decreases. So we must be paying them. So that's an outflow of 200,000. It increases again. And that is an inflow then of 500,000 Rand. So that deals with the movement in working capital. Then lastly, we just need to look at any purchases of capital investments or property, plant, and equipment. Now, in order to perform this calculation, I recommend that you reconstruct your PPE note. And it's a very, very basic PPE note. We start with our opening balance. We then deduct any depreciation for the period. This here is going to be my balancing figure. So whatever the balancing figure is, this will tell me if the company either purchased assets in the current year or if they sold them. And this must obviously tie into my closing balance. So where do I get all of this information from? Go back to your statement of financial position. Here's my non-current assets. So there's my closing balance for 20x7, 20x8, and 20x9. Remember, if I want the opening balances, you just take the closing balance of the previous year. So the closing balance for 20x6 is the opening balance for 20x7. The closing balance for 20x7 is the opening balance for 20x8. And the closing balance in 20x8 is the opening balance in 20x9. So that's where my balances come from. Here's my depreciation. So include those amounts in your calculation. And this is then your balancing figure. You force your PPE note to balance. So we can see for Avery Pty Limited, each year they've actually been purchasing assets. There's additions. Now please note, if it's an addition or a purchase, this must be shown as an outflow. Okay, obviously if we are buying assets, there's an outflow of cash. So if I look at my calculation just above, you can see that is shown as an outflow in each of those years. and that then gives me my free cash flow. Now, if we just stop our calculation here, we are assuming that the company will only exist for the next 3 years. So if we only take the cash flows for the next 3 years into account, we are going to undervalue the company. When we are valuing a company, we assume that the company is going to exist in perpetuity. And for that reason, we need to calculate a continuing value. So if you go back to your framework, we are now looking at the calculation of the continuing value. Now, please note, we follow exactly the same principle as Gordon's dividend growth model. So remember, with Gordon's dividend growth model, we take our future expected dividend and we divide by our cost of equity less growth. We are following the same logic over here. However, instead of using our dividends, we are using free cash flows. And instead of using the cost of equity, we are using our WACC as the discount rate. But the same logic applies. Now, we were told in this question, if we go back, that our cash flows are expected to grow at 14% from 20x9 onwards. So that is my growth in perpetuity. In step 1, we calculated our WACC. So we've got our WACC, we've got our growth in perpetuity, and we also have our free cash flows. Now, we have already dealt with the free cash flows for 20x7, 20x8, and 20x9. So we're now looking at the cash flow for 20x10. So that is the next cash flow that I need. So in order to calculate my free cash flow for 20x10, I take my cash flows from 20x9 and I'm going to grow that by 14%. So that is my free cash flow for 20x10. I then divide by my WACC less that growth in perpetuity. And that is going to give me a value. Now, we also discussed this when we looked at Gordon's dividend growth model. If I am including my free cash flows for 20x10 in the calculation, remember this jumps back 1 year and it's going to give me a value in 20x9. So I include this in my calculation for 20x9. I can then total all of my cash flows, and using the cash flow function on our calculator, we are going to calculate our net present value. Please note your first cash flow is 0. If you don't input that correctly, you aren't going to get the right answer. So the first cash flow is 0. Then the cash flow for 20x7, 20x8, 20x9. Remember, we use our WACC as our discount rate when we are trying to calculate our present value. And we have then completed step 2 of the calculation.